Hey there, it's Christine Keller with Century 21, and today I want to go over a little bit of the process of buying a home with you so that you can be educated, informed, and feel confident in the decisions that you're making on your home purchase. So I'm going to do a little screen share with you. Bear with me a moment. So here's my contact information, and I would send you some homes as we get started in the process for you to look at. Links to my website so you can search and save. And really, when we talk, I want to know what's important to you in your home purchase. I want to know your needs as far as bedrooms, baths, locations, schools, payments. Anything that may be important to you is important to me. And you don't have to worry about, you know, hurting my feelings about how you feel about a property. The more that I can understand about what your needs are, the best that I can help you moving through the process. So one of the first things to understand when buying a home is, are you going to pay for it with cash, or are you planning on using financing? So the money in the financing is usually the most stressful part of buying a home. So if you plan on using financing, we want to determine which loan would fit your needs the best. So typically there's three different types of loans. You have an FHA, a VA, or a conventional loan. And all of these are great depending on what your needs are. So FHA is super common for a first-time home buyer. It has a 3.5% down payment. So if you spent $100,000 on a home, that would be approximately $3,500. If you're going to use a VA loan, which you may be entitled to if you ever served in the military, then you would have a zero down payment, which is one of my favorite loans, really, because there's no down payment, so less money required, and it doesn't have private mortgage insurance, which FHA loans have. So your payment would be slightly cheaper if you have a VA loan benefit to you if you bought the same $100,000 house versus an FHA loan because of the private mortgage insurance. Now, VA does have a 2.25% funding fee, and that would be financed into the loan. And that's the difference really between your FHA and your VA loans, but they are very similar. And conventional loans are bank loans. The down payment on those can range between 0% and 25%, depending on what's available in today's market. We will talk about those. There are some first-time homebuyer programs that are within some conventional loan programs. And first-time homebuyer programs are really good if you don't have a VA loan available to you, because they would help you with the down payment that typically you would have on other type of loans. So VA loan to me is better than the first-time homebuyer programs, actually. But one of the most important things to realize is that when you finance a home, banks are going to want those homes to be in move-in condition. So you can't buy just any home with any type of loan. We want to look at the condition and make sure it's compatible, because fixer-uppers, a lot of your as-is properties, need too much work for the bank to loan money on. So we will look at those case by case depending on which ones that you're interested in. If you're looking around online on your home search engines, you'll find a lot of pre-foreclosure properties, auction properties, and those would not be able to be used for financing because they don't allow you to see them before you buy them. They don't allow you to turn on the utilities, and those would be a problem for the banks to do appraisals on. So if you're looking online, be very aware of what those are. And if you do find an address that you're interested in, then just shoot it my way and I can kind of give you the ups and downs on what you need to know about it and whether it would be compatible with the financing you're trying to use. So the payment, of course, would include not only your principal and your interest. Your principal would be your original loan amount, which would be the purchase price of $100,000 in this example. And the interest together gives you a fixed payment of $437 approximately at a 3.29% interest rate. but they also finance in taxes and insurance into your payment. So that is set aside. This part right here is paid into a savings account every time that you make a payment on the home. So this is to your benefit. So when those large bills come out every year for your taxes and your insurance, your mortgage company would pay it for you because you are budgeting it through your payment every single month. So your interest would be fixed. Your principal and interest will never change when you buy a home, but your taxes and insurance can fluctuate a little bit. So in this example of a $100,000 home, you're looking at a payment of about $437 total. And so we can change this example to fit your needs based on whatever payment you have in mind. But this is just a good start so that you can understand what is made of in your payment, what the banks are going to be looking for as requirements to do the loan, and the down payments that would be required. So in the next example, we're going to talk about closing costs, because when you finance a home, closing costs is a big part that people need to be aware of. Closing cost is usually a lot more expensive than what people think. So they are a combination of all the fees for everybody that's involved in the transaction that make it happen. Between the bank, they have loan fees, processing fees, underwriting fees, credit reports. In Georgia and South Carolina, attorneys are required to be involved in the transaction to make sure that it's handled legally. They will check the title to make sure that the seller actually owns the home and that they pay off all their debts, liens, taxes attached to the house before they sell it to the buyer. This is a requirement in the state of Georgia and South Carolina to have marketable title. The banks are not going to loan money on a home that doesn't have marketable title. And by marketable title, I mean you can get title insurance. So if a bank is going to loan you $100,000, they will always get lender's title insurance. Lender's title insurance protects the bank's money if they ever needed to resell that property. Since they have most risk involved, they want to make sure that if you don't make your mortgage payment and they needed to resell the home to get their $100,000 back, that their money is protected just in case the attorneys made any type of mistakes in the closing or in the title search when they did your closing. Now, owner's title insurance is often included in your closing costs too. I'm a huge fan of owner's title insurance. I've seen it save a lot of people a lot of money and hassle and stress, and hopefully you'll never need it. But it's a one-time fee, usually a few $100s, and I think that everyone should get it, because if you came into a serious problem on the title search when you went to sell the property, this is what protects you against mistakes that the attorneys made when you purchased that property. It covers for a lot of title problems, canceled security deeds, that would be other people's loans. Hopefully it's something that you'll never need, but it's one of those things that if you have it, you'll be glad that you had it, and it would be a very serious problem. I've seen it save a lot of closings and a lot of stress. So I'm a huge fan of owner's title insurance, and I don't sell it. It's even hard to explain all the situations that it would apply to, but I'm definitely in favor of people having owner's title insurance. The bank, of course, is going to order an appraisal, and they are going to make sure that the house is worth what you're paying for it. And they're also going to be making sure that the home meets the minimum property standards or move-in condition required by the loan that we mentioned before. So when the appraiser goes out, he's going to be looking for obvious problems with the home. Does the power turn on? Does the water turn on? Are there obvious leaks? Is the air conditioner turning off and on? Rotted wood, cracked glass, hazards, unsafe conditions. These are things that the bank would require to be fixed in order for them to loan the money. They don't loan money on homes that need too much work because it's a bigger risk for them. So the appraisal is also protecting you in that you don't want to pay too much for the property. So the appraiser If you found something wrong, like a cracked window, then we could ask the seller to repair that window in order for you to get the loan. We do this in your original offer if you're going to be using any type of financing like FHA or VA to protect you if something minor does come up on your appraisal. But a lot of homes that are sold as is, auction, pre-foreclosure properties, a lot of these properties are unable to be financed for this reason because they're sold as is. They're not willing to turn on utilities. They're not willing to make repairs. And so that makes it incompatible with a lot of financing. Mortgage insurance is another fee that would be involved in your closing cost. Sometimes if you have a rural property, they can require septic and well tests to be satisfactory, foundation inspections, surveys. I need to go back. And then your prepaids would actually be your property taxes and your insurance. Those are going to be paid up for the first year at the closing table so that you're covered for the first 12 months. And then after you have paid 12 months worth of payments, they will take the money that you've paid in for your taxes and insurance for the first 12 months and put aside into the savings account, and they will actually pay these bills for you so that you don't have to worry about budgeting for these big bills by yourself every year because they are really important to be paid. Property taxes can put liens on your home if they're not paid, and the insurance covers you for hazards like fire. So the bank wants to make sure that these items are covered. And your closing costs can range anywhere from $5,000 to $10,000. And you don't necessarily have to pay these bills out of your pocket, but ultimately they are buyer's fees. So we have to be aware of what these are so that we can effectively negotiate the very best deal for you based on what your financial needs are. It's very common for the seller to contribute towards these costs in our market, but we need to know exactly what they are when you get pre-qualified. This is one of the reasons why getting pre-qualified is really important before you find a home or even begin your search, because when you get pre-qualified, they will give you a loan estimate on what these closing costs and prepaids will be. They will communicate it with your realtor like myself, and that will help us form the very best offer to give you the best deal on the property based on what your financial needs are moving through the transaction. Some people cannot afford to pay their closing cost of $5,000 or $10,000 even if they wanted to. They're just getting by with the amount of money that they need for upfront costs like down payments and inspections. If they had to pay another $5,000 or $10,000 in closing costs, there's no way they'd be able to buy a home. We have some buyers that have, bought several homes before, and they have the ability to pay these closing costs in higher price ranges, but we need to know what your goals are. We can help you get the very best deal if we know all of the information up front, but not preparing properly leaves rooms for errors and negotiations, and my job is to make sure that we make this as smooth as possible, and nobody likes to have money surprises going through the process. So when you make an offer, we don't want to, ask the seller to pay $5,000 in closing costs, and then the cost end up being $10,000, and that means that the buyer would need an extra $5,000 that we didn't plan on. We do not want to have money surprises moving through the process. So that's why it's really important for us to know exactly what price ranges you're qualified for to get the payment that you want and what the costs are on your loan before we get started with actual house hunting. So we can help you with any home that's for sale. It doesn't have to be a Century 21 property. And it doesn't matter what website or whose sign is in the yard. We get paid based on when a property is listed for sale, they have already agreed to pay a commission to the realtors. And that fee is split up among the realtors when it sells. So buyers do not pay for a realtor in our market, which is to your benefit because that means essentially you get to use a realtor for free to help you go through the entire process, from learning what the process is to getting pre-qualified, comparing loan costs, interest rates, payments, closing costs, prepaids, preparing what your numbers are to get you the very best deal, to showing you homes and helping you through negotiation processes and all the way to the closing. The only instance in which you would pay a realtor is if you decided that you wanted to buy a home that was not listed for sale, like a for sale by owner. In that case, you would have the option to say, hey, I would like to buy this for sale by owner because it fits my needs the best, and you would opt into paying your realtor at that point. So we can talk about that if that instance should arise, but it's very rare. Another huge thing to take notice of is how much money you need to get started. So whenever you buy a home and you're making an offer on a property to someone, you would put up an earnest money amount. This is a good faith money that shows your seller that you are serious about buying the home. It's usually between $500 and $1,000. And if you went to a complete stranger and told them you wanted to buy their home for $100,000, if they accept it, you would put up $500 or $1,000 with the real estate company or the closing attorney to hold that offer for you while you go through the process, because it takes about 30 to 45 days from the time you say, okay, I'm going to make an offer, till you can actually close, because it takes 30 to 45 days to process a mortgage. So if you went to a complete stranger and told them you wanted to buy their home for $100,000, they'd probably have a really hard time believing you if they'd never met you before. So people put up earnest money so that they can have peace of mind that they can take their home off the market and that you're serious about buying the home. So if you don't close on the home, then you could lose your earnest money because you promised to buy it, and that was the whole purpose. There are some protections of your earnest money, like for a home inspection. Typically, we would negotiate 10 to 15 days in your home purchase contract that you could have the home inspected for any way you want at your own expense. That home inspection can range between $300 and $600 in an upfront fee to give you peace of mind that you know the condition of the home that you're buying. Because homes don't have return policies and buying a home is one of the most expensive transactions most people make in their lifetime, it's extremely important for you to have that home inspected. In some cases, we can request the seller to make repairs if something comes up and you're not happy with the condition of the home. If you can't come to an agreement with the seller in reference to a repair and something major did come up, you could back out and get your earnest money back during your inspection period. But if you back out after your inspection period, then you are putting your earnest money at risk. So between your earnest money and your home inspection, you're looking at upfront costs at a minimum $800 to $1,600 in cash to get started. And that does not include your down payments or closing costs that we talked about previously. Down payments and closing costs would be paid at closing. And after you put up earnest money on your contract, when you make an offer, shortly after you would get the home inspected. And then usually the bank would want you to go ahead and pay for your appraisal shortly after your home inspection. So if the house doesn't appraise, then the appraiser would get paid anyway, because he gets paid to provide the report to the bank for the purpose of value, whether the home appraises or not. So that's one of our jobs as a realtor, is to kind of help you determine if that home is going to meet the bank's requirements prior to going under contract with it, because we want to try to prevent you from losing that appraisal fee going through the process. So if you have any questions, give me a call and we will set up a time to go over any questions you have about this information. And this is just getting started. So, education is key. And I feel like the more information you know up front, the best informed decision you can make going through the process. And, getting all this stuff answered up front makes the home shopping process a lot more fun, easy, and less stressful. So my name is Christine Keller with Century 21, and my cell phone is 706-589-2003. And so give me a call and let's set up a time to chat a little bit further about your questions about the home buying process, and we will make sure that you understand them. So thanks for listening and have a great day.